We are diving deep today into Klarna, the Swedish giant that really put buy now, pay later, or BNPL, on the map.
That's right. And what a ride they've had. Years of just incredible hype, then a pretty spectacular crash, followed by this really impressive turnaround.
Yeah, quite the journey. So Klarna started out, well, pretty simply, right? Just installment plans.
Exactly. But they've evolved quite radically since then. So
hmm
our mission today is really to unpack this complex financial story. How did they manage that extreme volatility? How did they get back to consistent profit and pull off a huge recent IPO?
And that evolution, it's key, isn't it? They're not just BNPL anymore. It's payments, commerce, even banking now. It's a whole platform.
It really is. That's crucial to understanding where they are now.
So give us the snapshot. Financially, where do they stand today?
Okay, well, they've hit a massive milestone. Q2 2025 marked their fifth consecutive quarter of operational profitability.
5 in a row.
Yep. They reported, I think it was $29 million in adjusted operating income on revenues around $823 million.
Not bad at all.
And that consistent profit, it really helped validate their recent IPO. The company was valued at roughly $15 billion.
15 billion. So it seems the BNPL model, or at least Klarna's version of it, is, well, it's sticking around. It's maturing.
It looks like a profitable global fixture now, absolutely.
Okay, so let's unpack the value proposition. If you're a merchant, why bring Klarna into your checkout? What makes it this growth engine they talk about?
It's actually a pretty clever dual value proposition. For the merchants, it really boils down to boosting key sales metrics.
Like what?
Well, the sources we looked at show Klarna users drive something like a 40% increase in AOV, that's average order value.
40% higher. Wow.
And on top of that, a 46% higher purchase frequency. So you're not just selling bigger items, people are coming back to buy more often.
Okay, that sounds great. But what about the risk? The merchant isn't holding the bag if the customer doesn't pay, right?
That's probably the most compelling part for them. They get paid upfront and in full by
Really?
Klarna. Klarna takes on basically 100% of the credit risk and the fraud risk.
So bigger sales, more frequent sales, and zero exposure to bad debt. Yeah, I can see why that's compelling for a business.
Exactly. It's a strong pitch.
Now let's flip it. What about the consumer? We hear a lot about this simplified, sort of low-friction experience, especially appealing to younger people, maybe wary of credit cards.
Correct. They've definitely streamlined the checkout. It's fast. And often, Klarna uses soft credit checks,
Soft checks, meaning?
meaning they don't impact the consumer's credit score in the same way a hard inquiry for a traditional credit card application might. That's a big plus for many people.
Right, so you get the convenience instantly without all the usual paperwork or, the heavy feel of applying for high-interest credit.
Precisely. Less friction, immediate gratification.
And Klarna's product range, it's more than just one thing, isn't it? What are the main options people are using?
Yeah, there's a suite. The main one, the most popular by far, is Pay in 4. Simple structure. 4 equal payments, interest-free, spread out bi-weekly. Short-term, no interest. Very appealing.
Makes sense. What else?
Then there's Pay in 30 days. This is more of a try-before-you-buy thing.
Yeah.
You get the item, pay up to a month later. Again, no interest or fees if you pay on time.
Okay, those sound pretty straightforward, interest-free if you're punctual, but what about for, really big purchases? There's another option, right? The pay over time.
Ah, yes. And this is where it gets, well, significantly different. This is where Klarna acts much more like a traditional lender.
How so?
These are longer-term financing plans. Could be anywhere from 3 months up to 36 months.
Uh-huh.
And crucially, these are subject to interest.
Okay, interest. How much interest are we talking?
This is the really critical detail.
Okay.
Depending on your creditworthiness, the APRs, the annual percentage rates, can go as high as 35.99%.
Wait, did you say 35.99%?
I did. 35.99%.
Wow. Okay, that's basically credit card territory, maybe even higher than some cards.
It absolutely can be.
So here's the big question then. If their most popular product, Pay in 4, is interest-free, how on earth are they making enough money to be profitable and justify that $15 billion IPO valuation? Where's the cash coming from?
Right, and this is probably the single most important insight from our sources about their strategy. The key is how Klarna views that low-margin BNPL service, the Pay in 4.
How do they view it?
Not primarily as a profit center in itself. They see it as a massive data acquisition funnel.
A data funnel. Explain that.
They're essentially willing to break even, maybe even take a small loss on that initial Pay in 4 transaction just to acquire the customer and, crucially, their shopping data.
Okay, interesting. So if the interest isn't the main driver, where does the actual revenue, the bulk of it, come from?
Over 70%, maybe even more, comes directly from merchant fees.
Ah, the merchants again.
Exactly. When you, the consumer, use Klarna at checkout, the merchant pays Klarna a fee. It's usually two parts. A small fixed fee, maybe around 30 cents per transaction, plus a variable percentage of the total sale value. And that percentage can range quite a bit, sometimes up to 5.99%.
Whoa, nearly 6% on top of the fixed fee?
Can be, yeah. And given the sheer volume, Klarna processes millions of transactions every day. Those fees add up very, very quickly.
I see. So the merchant is paying a pretty hefty price for that guaranteed sales lift, and the zero risk Klarna takes on. That's what's really funding the operation.
That's the core engine, yes.
So what about the other revenue streams, the money they do get from consumers?
Well, that's primarily the interest income from those longer-term pay-over-time plans we talked about, the ones hitting up to 35.99% APR.
Right, the high interest ones.
They also collect late fees. If you miss an installment payment, it can be up to $7 per missed payment.
Okay.
And more recently, they've launched the Klarna card. So now they're also earning interchange fees, like a traditional card issuer, plus interest on cash reserves. It's diversifying their income away from just the core BNPL transaction fees.
So this whole strategy, using the basic BNPL as a sort of front door to build this wider ecosystem, that's what shifts them from being just a lender to more of a commerce platform.
Yeah. Exactly. That's the pivot.
How does that data acquisition funnel, as you called it, actually translate into these other maybe higher margin services?
Okay, so they have over 111 million active consumers globally. That's a huge user base. And with every transaction, they're gathering incredibly valuable first-party data on what people buy, when, where.
Shopping habits, essentially.
Precisely. And they leverage that data brilliantly. They sell performance-based marketing solutions back to their huge network of retail partners.
What's that look like? Targeted ads?
Think highly personalized ads, sponsored product listings within the Klarna app, maybe access to influencer or creator networks they manage. These are much higher margin services compared to the basic pay-in-4 transaction.
Right. So they make money helping the merchants sell more stuff using the data they got from the initial BNPL transactions, kind of circular.
It is. And it makes them less reliant purely on lending margins or merchant transaction fees. It builds that ecosystem.
Okay, let's talk market context. This BNPL space isn't standing still. It's projected to grow. What was the figure? A compound annual growth rate, a CAGR of nearly 50%.
Yeah, 48.4%. It's absolutely explosive growth.
Staggering. So in this booming market, how does Klarna really stack up against its main competitors? Like Affirm, Afterpay.
They each sort of carved out their niche, initially at least. Affirm, for example, tends to focus on bigger ticket items, think furniture, electronics, travel, purchases that might go up to $17,500 or even more.
So longer repayment terms, too.
Exactly. Their repayment plans often stretch out much longer, like 3 to 36 months, which makes sense for those larger amounts.
Okay. And Afterpay, they always seemed more focused on fashion and smaller buys.
That's generally their model, yes. Afterpay is often more rigid. Their classic product is that strict 4 installment plan paid over 6 weeks. Very popular in fashion, beauty, lifestyle categories where average order values tend to be lower.
Tighter risk control with the shorter cycle, maybe?
Potentially, yes. It's a different risk profile.
And then you've got the giants, like PayPal. They already have millions, maybe billions of users. How do they compete when BNPL is Klarna's whole reason for being initially?
PayPal's biggest advantage is just sheer scale and existing integration. They rolled out their own pay-in-4 service pretty seamlessly.
Because they're already everywhere.
Exactly. Nearly every online checkout already has a PayPal button. They didn't need to build a merchant network or a user base from scratch. They already had it. It's instant reach.
But looking at the sources, it seems Klarna does have some specific features, especially for merchants, that give it an edge.
They do, particularly around flexibility for certain business models. Klarna offers things like subscription billing.
Oh, interesting. For recurring payments.
Yeah, big streaming services, subscription boxes, software. Rivals like Afterpay, and even Affirm sometimes, don't really support that model as smoothly. That makes Klarna attractive for those kinds of merchants.
Anything else?
They also offer net terms and invoicing options for businesses, with payment windows from, say, 14 up to 60 days. That kind of flexibility, plus their really broad global footprint, US, Europe, UK, Asia Pacific, gives them an edge over some competitors who might be strong regionally but not globally.
It feels important here to really understand the fundamental shift Klarna drove. BNPL operates differently from traditional credit cards, and that's a big part of why it caught on so fast, right?
It's a critical distinction, absolutely. Traditional credit cards work on revolving credit. Now, you pay a minimum, the interest compounds, the debt can kind of roll over it indefinitely if you're not careful.
The debt spiral potential.
Right. BNPL, at its core, is different. It's typically a fixed installment loan tied to a specific purchase. There's a set number of payments, a clear end date. Psychologically, that just feels less daunting for a lot of consumers.
Less open-ended.
Exactly. And that pressure, that consumer preference shift, has forced the legacy financial players to react. That's why you saw Block, formerly Square, buy Afterpay.
Yeah.
It's why Apple launched its own Apple Pay Later service. They had to respond.
Okay, let's circle back to Klarna's own journey. We mentioned the volatility. That valuation roller coaster before the IPO was, well, pretty wild. Can you walk us through that again?
It really was a textbook example of the whole fintech boom and, well, the subsequent correction. Klarna's valuation absolutely soared during the pandemic boom. It hit a peak of $45.6 billion in 2021, just astronomical.
$45 billion.
But then, as the market sentiment shifted, interest rates started rising, investors got wary of high-growth, cash-burning tech companies.
The tide went out.
It really did. Klarna's valuation plummeted by a shocking 85% in 2022, down to just $6.7 billion.
Ouch. 85% drop.
Huge. So the fact that they managed to stabilize, cut costs, drive towards profitability, and then execute that $15 billion IPO recently, it really shows some serious strategic maneuvering and regained investor confidence in their path forward.
So that turnaround, getting back to consistent operational profit, what were the key things they did? What levers did they pull?
Two big ones stand out from the material we reviewed. First, a really aggressive embrace of AI for efficiency.
AI? How so?
Get this. Klarna's AI assistant apparently handled something like 2.3 million customer service conversations in its first month alone.
2.3 million in 1 month.
Yeah. Think about the scale of that. The company explicitly stated this drove significant operational savings and directly helped profitability, partly by leading to the replacement of around 700 customer service roles.
Wow. 700 jobs replaced by AI.
That's a stark indicator of where things are heading.
It really is. A powerful, maybe slightly chilling example of AI's impact on costs right now.
Okay, so AI was one lever. What was the other?
Strategic growth, especially in the crucial U.S. market.
Ah, the U.S. expansion.
Exactly. They saw really strong growth there. I think it was 38% year-over-year revenue growth recently. And a massive win was securing the partnership with Walmart.
Walmart, what did they do there? They became the provider for Walmart's own BNPL service, called One Pay Later. And interestingly, they actually replaced their rival Affirm to get that deal.
Kicking Affirm out of Walmart, that's a huge coup.
Absolutely massive, embedding yourself into arguably the world's largest retailer. That's a game changer for reach and volume.
And presumably they tightened up on who they were lending to as well.
Definitely. Alongside the growth and efficiency drives, they significantly improved their risk management. Their global credit loss rates, or delinquency rates, dropped quite a bit, down to about 0.89% in Q2 2025. Much healthier.
Okay, so profitability, AI efficiency, big partnerships, better risk control. It sounds like they've navigated the storm, but there's still a big cloud on the horizon, isn't there? Regulation.
This is arguably the biggest headwind, yes. The very things that made Klarna and BNPL so successful, that super low friction, the fast approvals, are exactly what's attracting intense regulatory scrutiny.
It's like their superpower is also their Achilles heel.
Kind of, yeah. Regulators, especially the CFPB, the Consumer Financial Protection Bureau in the U.S., are looking very seriously at classifying these BNPL providers essentially as credit card companies.
And if that happens?
Well, that could trigger a whole wave of new requirements. Things like mandatory, potentially more rigorous affordability checks before approving someone.
Slowing down the process.
Exactly. And also forcing them to offer the same kinds of consumer protections that credit cards have, particularly around handling disputes and processing refunds. That could add complexity and cost and really dull that key advantage of speed and simplicity at checkout.
And this isn't just theoretical, right? There's already been action in Europe.
That's a really important precedent. Klarna was hit with a pretty substantial fine, I think around $50 million from the financial regulator in their home country, Sweden.
For what?
The regulator cited significant deficiencies in Klarna's anti-money laundering AML protocols.
Yeah.
So it shows that regulators are willing to act, and they're targeting these potential systemic weaknesses that can arise from super fast, sometimes unchecked, growth.
Okay, so regulatory risk is huge, but then there's the other side of the coin, the potential for consumer harm. We hear stories about people getting into trouble with BNPL.
Yes, and that's the other major concern fueling the regulatory push. The sources we looked at mentioned a statistic that something like 40% of Americans who've used BNPL actually regret doing so.
40% regret it. Why? Overspending.
That seems to be a big part of it. The psychology is powerful. Splitting a purchase into 4 smaller payments just makes the total cost feel less significant at the moment of purchase. It can definitely encourage people to buy things they might not otherwise afford or buy more than they intended.
And while the pay in four is interest-free, those longer plans.
Those carry real risks, especially with APRs up to nearly 36%. Let's take a concrete example.
Yeah.
Imagine someone buys a, say, $500 winter coat using one of Klarna's 24-month pay overtime plans.
Okay.
Depending on the interest rate they qualify for, plus potential late fees if they miss a payment, that $500 coat could easily end up costing them over $700 by the time it's paid off.
Wow, an extra $200 just in interest and fees.
Exactly. That's a significant loss for the consumer. And regulators are also pointing to the volume of complaints they receive. One source mentioned over 2,600 complaints about BNPL providers, including Klarna, in just 3 years.
What kind of complaints?
Often related to billing errors, difficulties getting refunds processed, or problems with customer service when things go wrong. These narratives provide powerful ammunition for those advocating for stricter rules.
Okay, so we've covered the incredible growth, the near collapse, the impressive turnaround, the profits, but also these significant looming threats from regulation and consumer debt issues. So what does this all mean? What's the big picture takeaway on Klarna?
I think the main takeaway is that Klarna has absolutely proven that the core BNPL concept can be profitable and it can scale globally. But crucially, they did it by diversifying, by building that wider commerce ecosystem beyond just simple lending.
They're not just a payment button anymore.
Right. They're a shopping app, a marketing platform, increasingly a bank. However, and this is the big but, the very foundation that allowed them to grow so explosively, that low-friction, easy-access model, is the exact thing that's now attracting this potentially crippling regulatory attention and raising valid concerns about consumer debt.
It's a real balancing act for them now.
It is. And the sources suggest their strategic priority really has to shift now. Less focus on pure maximum growth at all costs and more on operational excellence, risk management, and especially transparency.
Transparency, how?
Making their fee structures, particularly on those high-interest loans, crystal clear. Making the terms and conditions easily understandable. Basically, getting ahead of the regulators by demonstrating responsible practices while still pushing forward with those higher-margin ecosystem services.
In this whole situation, it has implications far beyond just Klarna, doesn't it? What about the traditional banks and credit card companies?
Absolutely. The analysis strongly suggests that traditional financial institutions simply cannot afford to ignore BNPL anymore. It's not a fad. It's a fundamental shift in consumer payment preference for certain types of purchases.
So they need to adapt.
The recommendation is clear. They should be looking to integrate similar point-of-sale installment loan options directly into their existing credit card products or digital banking platforms. They need to compete on convenience.
Which leads us perfectly into our final thought for you, the listener, to mull over.
Right. If the big established credit card companies with their deep pockets, their existing regulatory infrastructure, their established customer protection processes, if they successfully manage to copy the convenience and the fixed-term appeal of BNPL.
While potentially offering better underlying protections because they're already regulated banks.
Exactly. What does that mean for the future of the standalone BNPL players like Klarna, Affirm, Afterpay? Is the real battle ahead going to be fought purely on customer experience and merchant partnerships? Or is it ultimately going to come down to who can best navigate and comply with the inevitable wave of regulation? That seems like the crucial question now. Where will the true competitive advantage lie in the next few years?